Time report on CNBC TV 18. Now let's talk about the FMCG space. We have Varun Lohchab, the head of India research, CIMB Equities, who joins us to track the FMCG space. Thanks so much, Varun, for joining in. Varun, more analysts are now pricing in a moderation in volumes growth for the second quarter. How are you anticipating volumes to pan out for the second quarter?
Yeah, for Q2, we believe volume growth will be at best, flattish on a sequential basis for most of the companies, and in fact, for some of the companies, we are actually seeing a moderation. So, because rural growth has been quite muted. So, as per our channel checks, urban demand is sort of flattish. So, there is no uptick or downtick in terms of urban consumption, but on rural there is slight downtick. So, volume growth for most companies are at best flattish to slight moderation compared to Q1 levels.
Okay, in your note, you're particularly underweight on mid-cap FMCG companies. What's the rationale?
So I think if you look at the valuations for the mid-caps, they are trading at a significant premium to large caps for most of the staples companies. So that's why we believe risk-reward becomes more unfavorable in case of mid caps, because most of them are trading at 40 times plus on a 1 year forward PE basis, whereas I don't think the growth differential for those companies will be much higher going forward. So the margin tailwind which is there will remain only till Q2 and for some extent say Q3, and post that the earning growth moderation will happen for most of the companies because top line growth is not coming in. So therefore, the mid-cap valuations, are making us more cautious on them at this moment.
Okay, then Varun, do you anticipate further expansion in margins owing to declining commodity prices, or do you expect the advantage to moderate as well? How are you reading the advertising as well as promotion spends, and also what will their impact be on the margins?
So on commodities, we don't have a very strong view. What we have assumed is that the current commodity prices will continue into the rest of the year as well as next year, FY17. So, most of the commodities have already fallen quite a lot, and we expect those sort of lower prices to prevail over next 12 to 18 months. If they fall further from here, then we could have some potential margin upsides in FY17 as well. But that scenario, as of now, we are not building in our base case. If you look at A&P, we expect uptick in this quarter also, and that to continue in the next few quarters, because the gross margin expansion will be plowed back by most of the companies because the volume growth is not coming in. And we are seeing rise in competitive intensity in a lot of the categories like detergents and soaps and biscuits, where you are seeing lot more promotions on the ground. And therefore A&P will remain at elevated levels and probably even inch higher from what we had seen till Q1. And commodity prices, we have assumed that will stay at these levels for the next 12 to 18 months.
Okay, Varun, you have a buy on ITC, and that seems to be your only buy in the consumer staples space. Tell us why, because the stock hasn't done too much, at least in the last few months.
Yeah, so in pure staples, we have ITC as the only buy, and we have Titan as the other buy in the sector, which is more consumer discretionary. I think in case of ITC, our view is that the worst of the volume decline is over. If you look at Q1, we had almost a 16-17% sort of a volume decline in cigarettes, and we expect that to slightly look better going forward. Q2 we are expecting another 13% sort of a volume decline on YOY basis, but in second half we expect volume growth to kind of come to a very small decline number on a low single digit sort of a number. So the EBIT growth trajectory and the overall earning trajectory of ITC will improve in second half, and valuations out there are quite reasonable at 20 times FY17. I think vis-a-vis the sector where we expect the earning growth to actually moderate into second half as the tailwind of margins will go away. So I think the earning growth for ITC will start to converge with the rest of the staples companies from second half, and therefore the valuation discount that ITC is trading at, I think makes it fairly attractive in our view.
Okay, Varun, but you've also recommended switching from Jubilant FoodWorks to Titan. What's the rationale behind that?
So Jubilant, we have we had recently downgraded. If you look at our post Q1 numbers, stock is at around 1800 rupees. We believed the risk reward was not looking as attractive. So we have downgraded it from add to hold. And Titan on the other hand, we have upgraded post Q1 from hold to add. So therefore, we were recommending that, investors with a 12 to 18 month view should start kind of accumulating Titan at these levels, because risk reward is attractive. Again, on Titan, we believe that, the jewelry demand has probably seen the worst. Q2 will be a weak quarter, but that is more or less expected, because, last quarter in the base, we had a big number from Golden Harvest scheme, winding down. So I think if you exclude that, we believe earnings will be quite reasonable. And, that will probably accelerate going into second half. Plus, we'll have the positive impact of the new Golden Harvest scheme. So I think the earning growth trajectory and the overall jewelry growth trajectory will improve in case of Titan going forward. In case of Jubilant, it's a hold for us. I think at a lower level, one can probably look at it, but at current levels, I think valuations look full to us. And we don't believe that SSG will have a very sharp recovery from current levels of around 4 to 5%, which they have been witnessing in last couple of quarters.
All right, Varun, thanks so much for joining and giving us your view on the entire FMCG space.